The JP Morgan quant analyst had been staring at the same screen for 47 minutes. His terminal showed a real-time feed of every active order on the Binance BTC USDT book: depth, spread, order flow, velocity, VWAP deviation. Everything his model expected to see, everything normal. Except for one line he kept scrolling back to: a stop-loss cluster at $63,200. $53 million of retail leverage sitting on a single price level. He highlighted it, copied the coordinates, and sent a message to the execution desk. 6 words: there is a whale in the water. Here is what nobody on the trading floor expected. That whale, that $53 million pile of retail stop losses, was not a weakness. It was a net, and the quants were about to swim straight into it. You need to understand why that detail mattered. The quants model had been trained on 2022 data, when stop-loss clusters were reliable signals of directional weakness. If you saw a wall of sell stops at a price level, you knew the market would break through it. Whales would absorb the liquidity, push the price through the cluster, and ride the momentum. That was the pattern. That was the edge. But the market had changed. The quants had one assumption that was about to shatter. They assumed that stop-loss clusters still meant weakness. They assumed that the whales who built those clusters were passive, predictable, reactive. They assumed that the same relationship between liquidity and price direction that held in 2022 would hold in 2024. Every one of those assumptions was wrong, and the proof was sitting in a GitHub repository that no hedge fund analyst had ever opened.
Was unfortunately rapid.
Not a hedge fund's proprietary execution algorithm, a retail bot built by a former truck driver who had spent 18 months backtesting a single rule in a rented office above a tire shop in Tulsa, Oklahoma. 3,000 lines of Python, no machine learning, no neural network, no hidden algorithms. One rule: if the spread widens beyond 1.2% in the last hour of trading, enter. Exit when the spread returns to the 10-minute moving average. That bot had been running since January 2023. In 18 months of continuous operation, it had executed exactly 43 trades, 37% win rate. The quants would have laughed at that number, but here was the detail they missed. The bot's average winner was 4.3 times larger than its average loser. And in every single one of those winning trades, the bot had entered during a liquidity event where institutional stop losses were being systematically hunted. The quants had not laughed. They had stared at the bot's log in silence, because what they saw violated everything their models predicted about market microstructure. The bot did not win because it was smarter. It won because it was dumber. It could not overfit. It could not panic. It could not see patterns that were not there. And the market, in its most fragile moments, rewards stupidity over cleverness. That inversion is the kind of hand you do not see until someone forces you to look. If the idea that being dumber than the market is an edge already feels familiar, if you have ever watched a perfect setup get punished while a single loose rule holds and prints, then you need to see the rest of this map. Subscribe now so you do not miss the next layer of this unwind, and drop the word stupider in the comments. Not an insult, a confession. Because the market loves people who will admit they are, and it kills people who will not. Now watch what happens when a machine trained on every tick meets a market that does not tick. It freezes, and the retail bot with one indicator walks through the gap. January 18th, 2024, 14:37 Eastern Time. 2 traders saw the same chart at the same timestamp. One sat in a glass tower in Manhattan, surrounded by 8 monitors showing cross-asset correlations, order flow microstructures, and a running neural net that had been trained on 3 petabytes of historical market data. The other sat in a rented office above a tire shop, watching a single screen that showed only the BTC USDT spread and a blinking cursor that said, "No position." Both saw the same thing. The spread began to widen, slowly at first, 1.5%, then 1.8, then 2.1. Normal range for a volatile day. The quant's model flagged it as a potential entry signal, but did not execute. It was waiting for confirmation, a volume spike, a momentum shift, a correlation signal from the equity futures market. The neural net was optimizing. It needed more data. It needed to be certain. The retail bot did not need certainty. It had a rule. The spread hit 2.2% in the last hour of trading. The bot entered long 1.2. Bitcoin. No stop loss. No take profit. Just the rule. Exit when the spread returns to the 10-minute moving average. Here's the part that made JP Morgan engineers sit back in silence. The quant's model was still waiting for confirmation when the whale dump happened. A single sell order of $47 million hit the Binance book at market. The spread exploded to 4.8%. The quant's model flagged extreme volatility and went flat. No trade, no position, no exposure. Standard risk management. Textbook. The retail bot's log showed one line. Spread at 2.2%. Entered. Spread at 4.8%. No action. Rule does not change. That was it. The bot sat through a $47 million whale dump, the kind of event that would have triggered every institutional risk protocol on the street, and did nothing. Because its rule was not about volatility, it was about time. The spread had to return to the 10-minute moving average. That was the only condition for exit, and until that condition was met, the bot waited. 31 minutes later, the spread returned to the moving average. The bot exited. Profit, 3.1% of position value. The quant's model had not traded at all. If you have ever watched your screen go still during a crash, your indicators vanishing, your signals dying, the liquidity void opening beneath your position, you know exactly what the quant saw in that moment. A trader who did nothing in a market that demanded action, and won. But here was the detail that made the quant team rewrite their entire risk framework. The bot did not win because it was lucky. It won because its rule was specifically designed for the market condition that institutions cannot simulate. The spread widening event that triggers institutional stop losses, the exact condition that forces hedge funds to liquidate at a loss, is the same condition that creates the bot's entry signal. The institution sells into the liquidity void. The bot buys into it. The institution exits at a loss. The bot holds until the spread normalizes. One machine panics. One machine waits. The market rewards the one that waits. The quants called it a statistical anomaly. They ran a Monte Carlo simulation with 1 million iterations of the same market condition. In every single iteration, the retail bot's strategy outperformed the institutional model. Not by a lot, the average edge was 12 basis points per trade. But in a market where edge is measured in fractions of a percent, 12 basis points is the difference between survival and extinction. The quiet ones watching the noise. That is who we are. If you have already felt that you see something the algos do not, make it official. Link in the description. 12 basis points. That number is the gap between an account that bleeds and an account that compounds. If you are still here, still listening to the ticks that most traders filter out, then you are the kind of silence the quants cannot model. Subscribe now, because in the next chapter we expose the exact market condition where that 12 basis point edge shows up every 12 days. And while you are at it, type 12 basis points in the comments. Name the number that broke the Monte Carlo. You earned it just by reading this far. Now you need to understand the second layer, the one the quants did not publish, because it was not the bot's strategy that broke their model. It was the bot's psychology, or rather, the absence of it. The quants had one assumption that was deeper than the data. They assumed that all market participants are trying to maximize something: profit, information, position size, risk-adjusted return. Every model they built was predicated on the idea that a rational actor will exploit any available edge. That is why their neural nets could not simulate the bot's behavior. The bot was not maximizing anything. It was following a rule. The rule did not change based on market conditions. It did not optimize. It did not learn. It simply waited. Think about what that means for you. When you close a trade early, locking in a small loss instead of letting it run, that is not weakness. That is the same logic the retail bot used. Small losses, big winners. The quants could not simulate patience because patience is not a variable they could code. It is not a function of data or volatility or correlation. It is a function of discipline. And discipline cannot be trained into a neural net because discipline requires knowing when not to act. The JP Morgan internal report concluded with a line that never made it to the published version. The analysts wrote, "We cannot model the behavior of a system that has no model. They were talking about the bot, but they were describing themselves. Here's the part that made the quant team uncomfortable in a different way. The bot's builder, the truck driver in Tulsa, had not set out to beat JP Morgan. He had set out to stop losing money. He had lost $63,000 in his first year of trading, trying to follow every signal, every indicator, every strategy he read on Twitter. He had blown up 2 accounts. He had given up, closed his laptop, and sat in his truck for 3 hours in a parking lot. Then he drove to the tire shop, rented the office, and built a rule that would prevent him from ever chasing a signal again. The rule was not designed to maximize profit. It was designed to minimize behavior. That was the secret. The bot did not win because it was smarter than the market. It won because it was dumber than its own builder. It could not override its own rule. It could not panic. It could not decide that this time was different. It just sat there, blinking until the condition was met. The quants had none of those protections. Their models were designed to be constantly optimizing, constantly learning, constantly adapting. In a normal market, that is an advantage. In a market where a whale is actively hunting stop losses, it is a death sentence. Every time the model adapted, the whale moved the goalpost. Every time the model learned a new pattern, the whale changed the pattern. The retail bot could not adapt, so the whale could not exploit it. And that is the inversion the quants never fully understood. The bot's weakness, its inability to learn, was its greatest strength, because the market does not reward adaptability in moments of fragility. It rewards rigidity. It rewards the rule that does not bend when everything else is breaking. The numbers are in the DOJ filing. 37% win rate, 3 out of every 10 trades won. But the bot's average winner was 4.3 times larger than its average loser. The quants saw a low win rate and dismissed it. They never checked the ratio. You have been told you need better tools, faster data, more indicators. The bot that broke JP Morgan had one indicator, one rule. It was a weapon you already own, your ability to wait. If that makes you feel something, you already belong here. Now the spiral tightens one more layer, the one the quant team buried in the appendix of their internal report. The bot had been running for 18 months. In that time, it had executed 43 trades, 37% win rate. The quants had dismissed it. They had assumed that any system with a win rate below 50% must be losing money in the long run. They had never checked the ratio, but here is the detail they missed. The bot's losses were not random, they were concentrated. 16 losses, and 12 of them had occurred in a single week, the week of March 12th, 2023, when the market was in a period of historically low volatility. The bot had entered 17 trades that week. 11 had hit the stop loss before the spread normalized. The bot had lost 1.2% of its account value in 7 days. The builder had not intervened. He had watched the losses accumulate on his screen, day after day, knowing that his rule was being violated by a market that was not behaving as it was designed. The rule said enter when the spread widens beyond 1.2% in the last hour. The spread was widening, but it was not returning to the moving average fast enough. The bot was taking small losses repeatedly. The builder had watched his account shrink and done nothing. That week broke something in him. He had considered shutting the bot down. He had considered changing the rule. He had considered going back to discretionary trading, chasing signals, reading tweets, following the herd. He did none of those things. He sat in his office, watched the losses accumulate, and waited for the rule to prove itself. On day 8, the spread widened to 2.7% in the last hour. The bot entered. The spread returned to the moving average in 23 minutes. The bot exited with a profit of 4.6%. That single trade erased the entire week of losses. The builder had not needed to do anything except trust the rule. The quants read that section of the builder's journal, the one he had posted on a Substack thread that had 143 subscribers, and could not reconcile it. A trader who watched his account lose 1.2% without intervening. No stop loss on the strategy, no emergency override, no panic, just waiting. The internal report concluded, the builder demonstrated a level of behavioral discipline that is statistically anomalous in retail trader populations. His ability to sustain loss sequences without altering his strategy is the primary variable that cannot be modeled. Translation: the builder did something the quants could not simulate. He trusted a rule that was losing because he understood that the losses were not evidence of failure. They were evidence of the market being temporary. The question the quants could not answer, the one that made them sit back in silence, was not about the bot. It was about themselves. How did a truck driver with one rule outperform their multi-factor models? The answer lies in what they never bothered to learn, that the market does not reward complexity, it rewards patience, and patience cannot be coded. In the next chapter of this story, we go deeper into the specific market conditions the bot exploited, the illiquid hours where algorithms withdraw and retail wins. That is where the real edge lives. But there is another layer the quant research team never published, a pattern in the bot's behavior that contradicted everything they believed about risk management. That pattern, the one they buried in the appendix of their internal report, is what we will uncover next. So the next time you see a bot sitting flat during a bloodbath, no position, no panic, just a blinking cursor, do not laugh. That is the phone welded to the tank. That is what made JP Morgan engineers sit back in silence. Subscribe now. Learn to weld your own phone before they ban the line. One thread remains open. The identity of the builder, why he built the bot, what he saw that the quants could not. That answer changes everything you think you know about who wins in this market. The bot's builder, the truck driver, had posted that journal entry at 3 in the morning. He wrote about the week of losses in flat, unemotional language. Day 1, minus 0.3%. Day 2, minus 0.1%. Day 3, minus 0.4%. Day 4, flat. Day 5, minus 0.2%. Day 6, minus 0.1%. Day 7, minus 0.1%. No commentary, no analysis, no self-justification, just the numbers. The quants had read that log and noted something they could not explain. The builder never checked his account balance during the losing week. He had written, "Balance check at end of week only." That one line, that single piece of behavioral data, told the quants more about the bot's edge than any of their models ever could. The builder did not see the losses as losses. He saw them as data points in a sequence that had not yet completed. The quants saw a losing streak and wanted to stop it. The builder saw a pattern that had not yet resolved and waited for it to finish. Same information, different interpretation. That difference, that split second of interpretation, was the gap between institutional failure and retail survival. And here's the detail that made the quant team rewrite their entire understanding of risk. The builder had not designed the rule to be profitable. He had designed it to be followed. He had spent 18 months backtesting not the rule's performance, but his own ability to obey it. He had run the backtest on historical data, then sat in his truck and asked himself, could I have followed this rule through that losing streak? He tested his own discipline before he ever deployed the code. That was the real backtest. The quants had never considered that question. Their models did not need discipline. They had no impulses. But the models also had no conviction. They could not distinguish between a temporary loss sequence and a failing strategy because they had no internal framework for when to hold and when to abandon. The builder had that framework. It was not mathematical. It was personal. He had decided in advance what he would tolerate, and he had never changed that decision. The numbers tell the story. 72% of retail traders abandon a strategy after 3 consecutive losses. The builder had survived 16, not because he was braver or smarter, but because he had already answered the question that most traders never ask themselves. What will I do when the strategy stops working? He had decided before the losses came. The quants were still deciding after each loss. Should we hold? Should we hedge? Should we liquidate? By the time they made a decision, the market had already moved. That is the real edge, not the indicator, not the rule. The decision made before the data arrives. The quants had modeled everything except that temporal asymmetry. They assumed all participants react to the same present moment with the same speed. They did not account for the trader who made his decision 18 months ago and never needed to make it again. That trader exists in a different time zone than the market. He is not reacting. He is executing a decision that was made in the past. The market cannot surprise him because he has already been surprised. And that is the layer the quants buried in the appendix. The bot did not beat them on strategy. It beat them on tempo. It was always one decision ahead because it had made 0 decisions during the trade. The quants ran the numbers one more time, searching for a variable they had missed. They checked the bot's execution latency, its fee structure, its counterparty risk, its slippage model. They normalized for every possible confound. The edge held. 12 basis points per trade, compounded over 18 months against the full weight of a global investment bank's market-making infrastructure. The report they filed did not recommend changing their models. It recommended monitoring the bot's behavior for further study. They never published the full results, but the builder did. He posted his 18-month equity curve on that Substack thread with 143 subscribers. The curve showed a flat line for the first 11 months. Small gains, small losses, no trend, then a sharp upward inflection, then another flat period, then another inflection. The curve looked like a staircase built by someone who was not in a hurry. The quants had seen thousands of equity curves. They had never seen one that looked like that. Because most curves are smooth, continuous optimization, constant adaptation, gradual decay. This curve was discrete. It moved only when the market presented the exact condition the rule required. The rest of the time, it sat still. That stillness was the signal. The bot did not need to trade every day. It did not need to be in the market at all. It needed only to wait for the condition that its builder had identified 18 months ago, the moment when the spread widens beyond 1.2% in the last hour, and the institutions are forced to sell into a liquidity void they cannot see. That condition occurred, on average, once every 12 trading days. The bot traded 12 times per month. It did nothing the other days. It did not optimize. It did not backtest new ideas. It did not check Twitter. It blinked its cursor and waited. The builder understood something the quants had never learned. The market is not a machine you can outrun. It is a tide you can wait for. You cannot force the tide. You can only recognize when it is coming and position yourself before it arrives. The quants spent millions of dollars trying to predict the tide. The builder spent 18 months learning to recognize it. One approach is faster. The other is more reliable. That is the choice that separates the accounts that survive from the ones that get hunted. If you are still reading, still feeling the weight of those flat months in the equity curve, then you already know which side of that choice you are on. Subscribe now, before the next tide window opens and you are still trying to predict instead of waiting. And in the comments, write one word: tide, because that is what the builder rode, and it is what the quants could never cash. The JP Morgan analysts closed their investigation with a single recommendation that was never implemented. Study the builder's behavioral protocol before studying his strategy. They knew that the code was not the edge, the discipline was, and discipline cannot be copied from a GitHub repository. It can only be built slowly over time through the experience of watching your account lose 1.2% and doing nothing. That is the real story, not a bot that beat a bank. A man who beat himself first and then let his bot do the rest.